What has changed, Chad, to make that the better play right now? What's different?
Great question. One is valuation. Two, it's the fact that you have a global economy that's starting to normalize back to trend growth. And three, you do have a lot of liquidity and euphoria in the market with valuations that are quite toppy. It just seems like everything is now a new asset class. With that said, you want to be just a little bit more circumspect. Buy the steady Eddie companies and don't try to chase the market at this point.
Hugh, I don't know whether you come down in the same spot in terms of sectors and types of stocks that you favor right now, but I do know that you are concerned about a slowing of growth from the macro standpoint, a slowing of growth rates economically, and a rising interest rate environment, which is not good news for PE multiples and the willingness to buy stocks. How troublesome is this environment to the broad markets, and how long do you think that troublesomeness is going to last?
Yeah, that's a great question. As a result of the numbers that we saw, the employment numbers for the month of August and lots of other numbers, the sharp decline in confidence, everybody's been revising downward their forecasts for the economy and earnings, importantly earnings, for the current quarter. Now you see companies falling in line, starting to give us some real hesitation about the earnings they might have for the third quarter and the fourth quarter. So we're getting downward revisions, as you've mentioned. We're getting a little bit of upward revisions to interest rates, not big ones. And you're right, that's a bad combination. I kind of agree with Chad in the sense that what he's talking about is he's talking about high quality companies. He's talking also about large capitalization companies. So if somebody's really worried right now, Tyler, if they're really price sensitive, you might want to do something like respond to what we're seeing in the markets, relative performance, and buy large capitalization companies. They perform well when we have problems in the stock market, much better than small and mid-sized companies. So that's a good idea. And you mentioned utilities, you mentioned consumer staples, companies like JP Morgan and lots of other ones. Companies that are large capitalization companies that offer pretty attractive yields. Again, if you're price sensitive, and that's the only reason you do this, you might reduce your allocation to equities, move to consumer staples and utilities, buy large capitalization companies of the sort that Chad's mentioning. In other words, play it a little bit more on the safe side. Now, remember one thing, which is important. This is an extremely volatile environment. Things could change on a dime. You could have prospects for the economy and earnings turn on a dime. And so you've got to be ready to change. But I think for the moment, let's say right through the fourth quarter and quite frankly, 2022, it's a time to play it a little bit on the safe side.